All right, welcome back everyone for Wook Capital Management's 15th Wook in Review. This week we have some interesting content to cover. Meme mania appears to potentially be back as this bear market-esque rally continues. But let me first off ensure that everyone is well aware that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. All right, with that mouthful out of the way, let me get my screen share up in the Discord again. If you are not a member of the Wook Capital Discord, we do share I share visuals while we record these broadcasts live. So if you're following along in Twitter, of course, you'll get audio. Joe's going to do his best to pin information to the nest here in Twitter Spaces, and I'll do my best to articulate what I'm kind of seeing on a screen if you are audio only. But yeah, we sent out the Wook in Review this morning. Again, if you're not signed up for the newsletter, we send it out every Friday morning. This is something that will never have any cost associated with it. And then we host these, of course, at the close on most Fridays. So it is a nice long holiday weekend for folks associated with the market with Martin Luther King Day on Monday. So we had a few interesting events going on this week. I think it's important to kind of go through the highlights first before we talk about our topics, which are in the realm of resurging meme mania and, of course, the one security that Wook has disclosed being long, PLBY. We'll talk a little bit about their amended rights offering from Monday and what is going on at PLBY. So very good. And again, just want to thank the folks who did take our year-end survey. We had almost 2 dozen respondents, so got some really good feedback. The one thing I didn't really put a ton of detail in the newsletter about, but I did want to verbalize a little bit, is that we'll begin to, as earnings season's upon us, certainly most of the big banks reported earnings this morning, and we're going to begin an earnings season process wherein once or twice a week, we schedule a spaces to start around 4:45, 4:50, where if you've been following us for a little while, you know we've done these for GME and for PLBY. Our anticipation is that once or twice a week, as we start this process up, we'll be covering a range of interesting securities from small cap to mega cap. Next week, we're actually going to kick things off. And Joe, if you are able to, I didn't create this survey, but folks who are listening would I'm going to leave it up to you. I was between starting our coverage on Tuesday with United Airlines. They report after hours on Tuesday, and they're the 5th largest global airline by market cap. Of course, United is the combination of Continental and United from a merger several years back. But my thinking was, as we've talked about in our coverage of these different Federal Reserve presentations over the past several months, the Fed chairman is clearly looking at the Fed chair and his peers are looking at housing related services inflation. So things like airline tickets go into that mix. And I thought it would be helpful to get a sense from United potentially around where they're seeing demand on both the consumer, leisure, and business travel side of things. Alternatively, if we were to not begin the coverage with United Airlines, Netflix reports earnings on Thursday after hours. And I think both of them are certainly interesting to kick things off with. I will leave it up to the survey to inform whichever one we decide to start with. Obviously, the peak of earnings season is a couple weeks out. We intend on recording a short earnings call primer so that folks who are more novice investors have a good resource to try and understand why the earnings call season is important. What are the things you should be looking for, listening for, reading about for investments of yours or prospective investments of yours. So that's to come. And I just wanted to kind of reiterate that the plan is, again, 1 to 2 of those a week. Earnings season will go really into Feb and March. So we'll begin those next week with either United Airlines or with Netflix. Joe, if you can maybe get that survey put together while I am talking and pin it to the nest. So then with that said and out of the way, let me cover our highlights. So CPI.
Yep, it's in the nest.
It's in the
now,
nest
by
now?
the way, people.
Okay.
So check out the nest.
Awesome. Great. So folks, if you are interested in United, respond as such. If you're interested in Netflix, respond as such. And we will go with whatever the people decide. Okay. So again, on my screen, if you're following along, otherwise, I'm going to verbalize it. We got the CPI data this week, right? Which has really been one of the most, important data points for the past several months now. As the Fed is trying to gauge the effects of its tightening over the course of 2022 and see, the goods inflation we've talked about for a while has clearly been nipped in the bud. The lagged effects of how rent-driven and owner-equivalent rent-driven calculations come about. It's still rising, but the Fed knows how that works and is anticipating it to continue to taper, right? The real-time data show on a month-over-month basis, for example, that a lot of rents have already rolled over for several months now. I pulled up on my screen. It's apartmentlist.com. This is an annual, so it's a year over year, not a month over month metric, but more than a fifth now of the 100 largest US cities have negative year over year rent growth through December. And there's a graphic here, there's a visual you can see if you're following the Southwest, California, Arizona, Nevada, and the Pacific Northwest in particular have seen much of that rent begin to taper off on a year-over-year basis. It's yet to hit Texas or Florida, two other hot housing markets. But those things are coming down the pike from an inflation perspective. There was a Wall Street Journal, I think their real-time economics newsletter is a great resource. If you're not subscribed to it, I encourage you to do so. They have a few good graphics. Again, I'm just kind of scrolling past them, but on a month-over-month basis, the headline number declined for the first time since the pandemic began. Now, the headline number is noisy. You have energy prices, a lot of volatility there. The core inflation figure still up month over month. However, the year over year continues to ease. And I think this graphic where you see core services, core goods, and then core CPI is really, again, the important thing is where are core services going? There was a good graphic as I scroll farther down here talking about airline tickets. Speaking of United Airlines, how airline tickets are still up massively, almost 30% from a year earlier, but they're off their peak and they are trending in the right direction. So again, the contributions from things like used vehicles, which we're going to talk about in a second, have turned negative on a year-over-year basis for a couple months now. So there's still, maybe it is in fact true that much of the inflation was transitory, driven by these supply chain bottlenecks and inflated goods demand from all the stimulation that went into the economy from CARES and other acts passed in 2020 and 21. However, there's clearly no answer, and it's not settled whether the longer term impacts of these average hourly earnings rising in excess of what would be a stable price environment. And of course, we now have this rapid China reopening into the mix and the effect on demand of that. and the ongoing geopolitical issues globally, which if there is a long-term trend toward deglobalization, which it appears that peak globalization may be behind us, then those are also inflationary things. And you have the short-term transitory versus these longer-term potential inflation tailwinds that are all floating around and making it difficult for policymakers. The bond market this week, Jeff Gundlach, a very renowned bond investor at DoubleLine, was noting that the market has made it clear, the bond market has made it clear that it expects that this inflation is largely transitory and behind us. However, the Fed speakers this week were all out and about, reiterating that as of now, their view is that they still must remain higher for longer. And there's a pretty big spread between what they are saying and what the futures, the Fed funds futures, are pricing. As we look out toward the back half of this year, that divergence widens into 24. So we'll see. So anyways, yeah, so these ongoing asset price normalizations, right? I think that it's fair to say they were distorted by Fed policy and by fiscal policy in 20 and 21, and of course the supply chain constraints, especially on the automotive side. The new vehicle inventories, for example, are up 81% year over year per Cox Automotive at the end of 22. So inventories are rising. They were very low. They're getting built back, and the question mark becomes, how low do prices go, and do you begin to see if those job losses that the Fed has expects close to 1 million in their base case, if you just go by the December dot plot, then what is the impact as folks, if they lose their jobs, if things play out as the Fed anticipates, even in a quote unquote soft landing, the expectation is that unemployment rises further. That how much of an impact do you start to see for lenders if foreclosures start to ramp, and obviously the bank earnings this morning, it's not there yet, but that's some of the big question marks for 2023 as the year progresses. So all right, those are the highlights. I'm going to go over the rights offering now. It looks like Joe's back. Okay. In the newsletter I wrote, on Monday, PLBY amended their previously announced subscription rights offering. Shareholders of record as of December 16th previously had the right to exercise these rights at $3.50 per share. I noted that the CEO sold several 100,000 shares just days before the offering, which of course harmed already degraded sentiment. And on Monday, the company amended the terms of the offering. So I was going to review a little bit about, look, if you're invested in a company, you need to follow what's going on. And sec.gov/Edgar is a great place to go to get company filings. You can go there. As you can see on my screen, if you're following along, I would simply type in the company's ticker, PLBY. I can see that there was an 8K, a current report filed. I clicked into it. Scroll through it, right? This contains both the press release and some added detail, and just talks about what is in fact this amendment to their rights offering. So the amendment was that holders of record as of the I forget what the precise record date was, but on the 19th of December, holders of record received the subscription rights, which were for 0.3068 yada yada of a share of common stock, and investors had the right but not the obligation to effectively buy shares at that price. Now the price of course declined below that in the interim, so the amendment is that it is now the lesser of $3.50 and 85% of the volume weighted average price for the 10-day trading period that ends on January 20th. So the language of the rights offering, it's not that you would, it's actually going to basically require, if I scroll a little bit further in the rights certificate, click into that, you can see that the way that it works is you must subscribe, assuming the subscription price is $3.50 per whole share. If the subscription price is determined to be less than $3.50, which it's now $1.13, and with the stock closing at $2.78 today and trading under under 3 all week, it's safe to assume, barring some meme mania spreading to PLBY, that the VWAP will be the lesser. But the way that the offer has been amended is the excess subscription, if the subscription price is less than that 350, if the VWAP, the 85% of that VWAP is under that 350, the excess subscription amounts paid would be applied to the purchase of additional shares of common stock, either toward your basic subscription right or toward your oversubscription right. For example, in my personal account, I have 20,000 shares. And if I were to participate, which I'll share my personal experience, I called TD Ameritrade today, and they have yet to receive the amended rights offering from the DTCC. So they still have the initial offering dates and times, which expired today at 11 a.m. So when I called them, unfortunately, there's no way I could participate. And I'm sure this has happened to many other investors who, saw the amendment come out this week and maybe were waiting to see how the week transpired. So it'll be interesting to see if the company has to, again, amend or extend the offering. They have the right to do so, I believe, through to the 23rd. So we could see another 8K at some point. And, oh, my fire alarm is going off. Lovely. We have a prime rib being cooked in the kitchen a couple feet away from me, so hopefully that's not loud in the background. I'm sorry. But anyways, yes. So that has been going on. I pulled up the Form 4 where you see that Bernard Cohn, the CEO of PLBY, sold about 300,000 shares on the 15th and 19th of December. So again, it's just really a horrific situation where there's really no governance cure because of the investor rights agreement that Rizvi Travers, the chairman of the board, has, and the CEO is also on the board. So really, it's whatever they want to do. We're along for the ride to an extent. And unfortunately, they're just very bad at managing most things. And selling all these shares right before the rights offering seems to have tanked it. So that's what's going on with our lovely PLBY. Happy to talk more about it, field questions, etc. Once I finish up with Meme Mania, and we kind of invite anybody up who wants to either ask questions or chime in. So yeah, I noted, look, this week felt awfully memey. I included a graphic of the share price charts of Bed Bath Beyond, AMC, GME, Coinbase, Carvana for the last 5 days. Obviously, this note went out in the morning, so we don't have today's data in there. But Bed Bath Beyond was up over 200% in the last 5 days. Carvana, 76%, this again through end of day yesterday. Coinbase 41, GME 27, AMC 27. So a lot of these heavily shorted stocks that some of whom we'll talk a little more about BBBY, some of whom I've already indicated that bankruptcy is likely imminent, have rallied meaningfully this week. On Wednesday, Bloomberg had reported that where is it? There it is. On Wednesday, Bloomberg had reported that the basket of most shorted stocks had jumped 4%. So markets themselves have obviously been hot to start the year, but the worst of the worst has done the best of the best, and that's typically not indicative of a new bull market. You wouldn't expect to see maybe all of these companies leading the way if it were in fact a bull market. We won't know, right, until hindsight tells us if it is in fact the bottom has been put in and we've exited the painful bear market of 2022 yet. So the close today, it's getting close to the people who like to draw lines on charts. Volatility has dropped again today. The VIX, it looks like, closed around, from what I'm seeing here from Koifin data, at 18 and change. So I believe for the VIX, that's the lowest close, at least since the war in since Putin's invasion of Ukraine. And yeah, it certainly looks that way. Just glancing at a quick chart here. So the volatility is quite low, and this rally over the last year to date, rather, Nasdaq's now up 5.5% year to date. S&P 4.1. But as I noted, these heavily shorted stocks are up the most. But just last week, Bed Bath noted that they're preparing to file bankruptcy within week, or excuse me, sources noted Bed Bath's preparing to file bankruptcy within weeks. This is Reuters reporting. Quote, the company said it was exploring a range of options to address its plunging sales that included declaring bankruptcy. The retailer said it has not made any final decisions on which course to take. So, as has been the case since Hertz, I guess, in 2020, company says it's going to file bankruptcy or does file bankruptcy, and we've seen with Hertz, we've seen with Redbox, with Revlon, with some others that for whatever reason that seemed like the opportune time for people to go long. So, I pulled up the Bed Bath filing. They'd indicated last week in that filing that they expected to file their quarterly report, their 10Q, on Tuesday. I didn't see that yet. So this was already a delay. This was the NT that their 10Q that they would be delaying the filing, and the company determined it's unable to file based on the significant deterioration in its performance, which included the evaluation of its results in conjunction with quarterly long-lived asset impairment testing. As a result of its financial performance, the company is updating key inputs and estimates used to perform its impairment testing and assess the corresponding results. It's taking significant resources from the finance team, and that they will be delayed in their filing. So that came from the company last week, and we had the big rally for shorts, heavily shorted stocks this week. So yesterday, I saw Bloomberg reported on the Bed Bath situation, and I kind of take some issue with the reporting because the bullets note shares soar for fourth day amid renewed retail trader interest. Rally could spur, quote, massive short squeeze, S3 Partners says. And then when I keep scrolling, I see, quote, retail traders have helped drive the latest surge, funneling millions into Bed Bath & Beyond and pumping their bets on social media, websites, and chat rooms. These investors snapped up 7.3 million of Bed Bath & Beyond stock Wednesday to more than double their net purchases since the markets closed on January 4th, Vanda Research show. So when I read that implies that stock purchases by retail since Jan 4 are less than or around $10-ish million, which, given the market cap rose by several $100 million, the math doesn't quite add up. I questioned this on Twitter. Let me just pull up maybe on my screen. I think I'm logged in on my personal account, and you can see if I can get the tweet pulled up that I noted this, and then my answer to the question, which I'd happily hear if folks have any other thoughts, was, I said, how are retail traders the primary driver of this if their purchases were under 10 million? And I think you have to look at the options chain, and you have to remember the history here. So obviously, we've covered, I had the opportunity to interview Jake Freeman in late July and early August twice before the first wild rally, talk about what his plan was to remedy the curiosity that was the very high amount of implied volatility priced into the stock. Meanwhile, was there a way for the company to capitalize on that? The company didn't. Obviously, there was then a short squeeze situation. The stock touched 30. And of course, Ryan Cohen, who had filed a 13D earlier in the year in March, exited his position, and then it seemed like the party ended at that point. So, I mentioned that they have the going concern language. This stock is heavily shorted, But this kind of graphic of the options chain, I think, is indicative of what's really driving things. There's such huge open interest, and we're talking about hundreds of thousands of call options on both this week that expired 35 minutes ago, as well as next week in particular, since January 20th expiration will be the annual big week, right? You can buy call options or put options for, there's monthly, there's quarterly, and there's yearly, and this is the yearly expiry. So with all of that hype that happened earlier in 2022, there's a lot of latent, just open calls, many of which I'm sure were down 90+%. But as the price began to rise, I note that dealer hedging activity is likely a culprit, because all of those open call options, they still have a delta, they still have an impact, even if they were out of the money. And it clearly looked like a short squeeze was, well, let me not say it looked like a short squeeze. The implied volatility that was being priced into the options chain felt and seemed awfully squeezy. You had, again, from this screenshot from yesterday, the at the money calls expiring in 1 week with an implied volatility calculated from TD Ameritrade at over 400%. So it's been higher. I remember over 600% in the case of Bed Bath during the prior mania in August. And of course, the case of the GameStop January 21 mania, implied volatility got over 1,000% on near dated calls and puts. So this looks like a lot of hedging, and there's probably a lot of players pushing things around. If you were a player last week that saw this chain on the 1013 and sorry, not 10, 113 and 120 chain, you might have thought, yes, I know this is going to zero, but can I, manipulate the price? And I'm not accusing any firm of doing so. Wook has no position in BBBY. I have no position in BBBY at this time. However, a well-capitalized player could probably put on a buy algorithm, and somehow, some way, the price ran from $1.30 or so last week to even today, with it being down, it closed over 350, which, per what I see in my TD Ameritrade here, it shows a market cap of 429. So the other interesting consideration, you can see I pulled up the Wall Street Bets post from yesterday. Wall Street Bets, of course, the Reddit sub made famous in the January 21 events, had noted that discussion on BBBY is now allowed since it meets their revised minimum market cap threshold of 500 million. And they noted that it would not be removed unless it falls below 400 million. So it looks like it'll be allowed to be on there for this weekend, and it's a long weekend. It'll be very interesting to see how much activity and discussion there is from Wall Street Bets. But it just highlights as I see it, the ongoing disconnect between prices can do anything in the short run. They can get severely disconnected from fundamental value, but that doesn't really mean anything. At this point, we don't know if the company's taken any action to monetize this renewed interest. The reporting yesterday after the close out of Yahoo Finance, I think it was Bloomberg originally reporting it, is that Bed Bath is speaking with potential lenders that would finance the company during bankruptcy proceedings. Talks include the potential for a so-called stalking horse bid, in which the party would also offer to buy some or all of the company's assets in a bankruptcy and set the low end of a bidding bar so that others can't offer less. Talks are in early stages and terms could change. So this is people familiar with the private negotiations, but they're not naming who it was. And obviously the Bed Bath spokesperson simply noting, reiterating their previous statement, they're exploring multiple paths to improve the outlook. And yeah, it's just very interesting to see. I think that this in particular is just driven by the peculiarities of the options chain, and whether there was an opportunistic fund or funds that saw this and seized on it and drove the price up. Who knows, right? It's awfully speculative. We can't know. But I think my point broadly is, when I see Bloomberg noting that the data from Vanda Research show net stock purchases of less than 10 million, and you see a market cap rising by 300 plus million, that they're kind of missing the forest for the trees there with that reporting. And they also noted that touts across platforms like Reddit's Wall Street Bets and StockTwits have accelerated in recent days along retail buying. And unfortunately, that's just simply inaccurate because Wall Street Bets didn't even add it until after the article came out. So, just kind of have to call out Bloomberg a little bit, even though I enjoyed reading their research, writing, and reporting. But that's kind of what's going on, at least with BBBY. And it's 4:40 on a Friday. I've wrapped up the extent of my prepared commentary on the matter. So I did put here in the note that, look, I posed the question: is there more upside to these rallies, these meme stock rallies, or are they indicative of a new bull market, or is this yet another vicious bear market rally? I think I've shared my opinion already, but I invite a vigorous debate during the call. So if anyone wants to come up, kind of talk about maybe why they're a bull on the market or on some of these individual names, I'd love to hear your takes. And if you have any questions about or comments on any of the topics, highlights that we covered today, we welcome you to chime in. Joe, I know I've kind of talked a lot there, and I'm glad to see that you were able to get back in. I wasn't able to take your call, but yeah, just to recap, Joe's got a few things pinned here in the nest kind of that we talked through. If you were to go all the way back to our second nested item about my initial question I posed, if you missed the beginning of the call, we are going to begin covering earnings calls next week. And if you would like us to start with United Airlines on Tuesday after hours, or if your preference is Netflix on Thursday after hours, please take the poll. We've only got 6 respondents so far. Netflix is ahead 4-2, it looks like. So Joe also has, interestingly, we have a sub tweet to that poll with the poll on: is retail driving the recent surge in Bed Bath stock? That has 24 respondents. And for now, the majority believe no. So anybody who's responded to the polls or otherwise, again, you're welcome to chime in on audio. Let me take a look at the chat here in Discord. And yeah, Joe, what do we got?
A lot of audio problems earlier on, Rod, but they seem to have all been fixed by now. Twitter was glitching out.
Thanks, Elon. He must have heard me talking about his price cuts and got mad about it. Okay. Well, I guess we'll see what the audio looks like in the recording. But yeah, sorry, guys. I have no way of, I guess, knowing that on my end. Hard for me to keep track of it. I don't know how many minutes it was out. Okay, yeah, I'm seeing people's comments in Discord. Sorry, folks. Hard for me to know that Elon's screwing with us. But anyways, Daniel and Chris both came up. Daniel, if you want to go first, please, the floor is yours, sir.
Thanks. I just this is a more of a personal question to Joe. I'm a big Ryan Cohen fan, and you got to do that interview, which was really awesome, and I really enjoyed that interview. Is there anything that you could share about the interview? I'm not asking for anything private that you're not allowed to share, but do you have any? Is there anything you could tell me additionally about the interview? Like, how did it work out? How'd you get it going?
Yeah, I mean, it was interesting. His team actually had proposed it over a year before it ended up finally coming together and being uploaded. So it was a long time in the making. I mean, he's a really busy guy. and I don't think his priority really lied in like speaking to an interviewer in that kind of capacity. So it took a while to pull it together, but when we finally began the actually speaking one on one, I mean, he had so much to say, and he wanted to put out all the best like stuff. He knew he wanted to have an interview that the retail investors would appreciate. It seemed something fun, but also something that dove into his background. And we felt like his background was going to be the most important thing to discuss because he can't talk about what's going on day to day at GameStop. That would be non-material. So it was nice to finally have him on camera for 40 minutes. I mean, all of his prior interviews had been 3-4 minutes long, and it meant a lot, obviously, to conduct it.
I've probably watched it like 50 times because I know in the last 2 minutes, and you don't have to confirm this or not, but I know in those last 2 minutes when he was talking about the refaces, I'm like, oh, he's thinking about me. Awesome.
Oh yeah, I'm sure he was. I'm sure he knows a lot of the people that tweet at him and takes note of him. I mean, I could tell when I spoke with him that he was just as enthusiastic about like the retail investors as anyone.
That's awesome. Thanks, Joe.
All right, good stuff. Yeah, if you hadn't seen it, I think it, whether you are a fan or not, I think it's a great interview just to get a sense. You know, this is clearly someone who's an entrepreneur who has a view that's outside of the typical, I guess, viewpoint, and he's a smart guy. And I enjoyed the interview. Certainly, think it's a worth a view for anybody, even if you're not a Cohen fan or if you're not an investor. Just hearing his perspectives on some things. I think half of it is in good fun. The interview, I think it's about 40 minutes, and half of it is more discussion on I guess more investing and business related things. But yeah, Joe did a fantastic job with it, and I know it was a long time in the making, so it was great to finally get it across that finish line. Chris R, our resident Bed Bath Beyond bondholder. Sir, how are you?
Not too great today.
Yeah,
Um,
down. Oh, I guess it's down more after hours.
I mean, the bonds are also trading down. They were going up with the stock for a few days as the hype was picking up. Um, there was this idea that I had that if it went up enough, that the company would do the right thing and dilute and pay off debt. But I guess that's not really on the table anymore. I mean, I don't know,
Yeah,
um,
right, because they
yeah.
didn't do that last time this happened, and I know they didn't, if I recall correctly, have an at the market offering in August, and I know they do have that open now. But I mean, look, I'm not at all an expert in the bankruptcy
Mm,
process at all, and like, given that they have the delayed filing, given they're in these reported conversations, for a potential offer, I know that some of the smarter folks I've seen on Twitter talking about it are of the view the company cannot currently sell equity, given those
mm.
conversations and the status. But that is an uninformed view of mine. Um, so I mean, I'd be happy to be proven wrong there.
I mean, I wouldn't say I'm more informed about you on this. I think when in August there was that end of month announcement that they were hinting at, and like that was part of the sort of speculation that they had this announcement at the end of the month. And I guess because they had some insider information or some sort of the announcing of that FILO and the ABL extension, then they they just figured that they can't legally sell shares or file. I know GME took a while. They took a couple of months to finally dilute after the meme mania started. So,
That's right, because GameStop is like many retailers, not on a calendar year quarter. So their fourth quarter ends. It runs through the end of January, and while these events were going on, I know the reporting for GameStop situation was that the company felt given it having that material information and having not disclosed that even though it had the open at the market offering, it couldn't sell shares, which of course it went on to sell shares in later months,
Mhm.
at pretty rich valuations still, which have obviously transformed their balance sheet. It's unfortunate for equity holders and creditors and Bed Bath that they were have been unable, it seems, to meaningfully seize this opportunity.
Yeah. Yeah. I mean, I don't know if I can really add much more to this at this point. There was that tender offer that they had that was really interesting. They kept extending it for like, I think 4 weeks or so. And they finally canceled it when this like bankruptcy speculation sort of thing, going concern announcement happened on the 3rd of this month, I believe. So I I don't think, um, yeah, I don't think there's really much hope for unsecured debt. Um, in terms of the assets of the business, the recovery, I don't know how much that's deteriorated. I mean, one thing, we don't have the 10Q yet, right? So like,
Right.
there's no way you can really know what the status of the balance sheet is right now, without the 10Q. I mean, not the 10K. So yeah.
I know I'm in the filing from last week from the company, and just quote, while the company continues to pursue actions and steps to improve its cash position and mitigate any potential liquidity shortfall based on recurring losses and negative cash flow from operations for the 9 months ended November 26th, as well as current cash and liquidity projections, the company has concluded that there is substantial doubt about the company's ability to continue as a going concern. I know there's a coupon due in a few weeks here for, they have 24, 34 and 44 bonds, and you know the details better than I, but it seems like if they can't make that payment, then it's really setting them down the path for filing, or it's kind of starting the default timer, right?
Yeah, and I think the fact that there's even doubt that they can make a $24 million payment on this debt is concern for sure.
So Chris, let me ask you this, because I know you peruse Wall Street Bets, and obviously the subreddit BBBY. Um, going into this week before this big run up, and the stock, the equity had obviously traded down meaningfully over the last, since it's been trading down all year, but for that kind of August blip. Um, was there a big sentiment change? Obviously, this resurgence in the price has drawn in a lot of speculators, but I guess as somebody who's been really close to it, what have you been observing this week?
I don't think the sentiment really changed. There was always this hopium about a buyout happening. There
Yep.
was these buyout rumors being posted every day. A lot of like wrong information being posted. Like, and I'm not gonna like hate on them because like for example, you were talking about the media, and like I remember you posted an article. It was like $1.5 billion of debt, and like that number is just wrong. So like it's lower than that. So I think that there was a lot of misinformation there, of course, being posted. People want the stock to go up, right? And they think it's true. They see some like, I think yesterday or the day before, there was like Ryan Cohen still has 2.7 million shares. People trying to post that on Reddit, and it's some old like Fintel. They have some like portal where you can see insider holdings, and like I guess the cell did an update or something.
Uh,
I don't know, but like all
that's
these
something I've
little,
seen a lot over the last couple of years. A lot of folks who are newer to markets, I think, will just go off of if they see something that they like, as opposed to trying to question if it's something that seems like it's not accurate. They're more
yeah,
interested in getting their bias confirmed than the truth.
yeah, they see Yahoo Finance, and like those cells on Yahoo Finance are just updated like without any concern for if they're true or not. So um yeah, so I think so I was getting back to what I was going to say was that there's no meaningful change in sentiment. What I did notice was the borrow fee last Friday
Yeah.
went up at after hours from 13% to 48%, and people saw this, right?
Right. And this
over
is
the weekend,
you're talking about interactive, because I know a lot of folks use iBorrow,
yes.
right? That's interactive brokers is a one of many. So it's not giving you the entire picture. This is something I
Hmm.
obviously didn't know about pre 2019, 2020, but having been intimately involved with GameStop, I got to learn a lot. Uh, that this is very much a spot market, and it's very much the
Hmm.
Wild West, and different brokers are going to have different lending rates, and
Yes.
there's interesting arbitrage opportunities, I guess. But right now it hasn't updated for interactive brokers, at least since the 9th. But I know you and I were talking about it earlier, and I have it up on my
Hmm.
screen. You can back into these borrows when you look at the options chain, because if you think about it, look, the implied volatility is not twice that of on the puts as on the calls. The math calc that is being done behind the scenes in TD Ameritrade and many brokers is not kind of capturing that cost of carry, the cost of borrow. So, for example, right now, I think the close was 366. If I look at, for example, January 24, roughly a 1 year term, the at the money or close to the money call, the midpoint was $1.60, the $4 strike, and then the at the money put was 315. So take that 315 less the 160 less that 34 whatever cents, and like I think we were talking about earlier, the implied annualized borrow, if you were to take advantage of the options chain, is in the mid 30%. But I guess that the spot market is obviously very, very tight right now, as evidenced
Yeah. And
by
you have
what
to
you were saying.
consider those are American options. So when you sell the option, like the call option, you give the buyer the right to exercise. So they can very
That's
easily.
right. I know. I don't know if you want to talk about red docs, but right there's
Yeah.
people can early exercise these in the money calls, and then if there's no shares that are locatable, you as
Yeah.
as someone short those calls who are now short shares could be in trouble. I don't know if you want to talk about your experience with that. Just maybe, if not, that's
Yeah, I
okay.
was the red box was kind of crazy. I was short just a few call spreads on that, and my call legs, my short legs of those call spreads kept getting assigned. And this is kind of a weird quirk that I found out by talking to support. But when you get assigned, you have to pay 1 day of borrow no matter what. And the borrow was like 900% at the time.
And that was interactive brokers.
That was on interactive brokers. But I think yeah, I mean, at that point, you really just have to, sell out of the money calls and hope they don't go in the money, or just stay out of it.
I don't want to get in trouble. My COO is listening. I won't disclose the security, but we experienced similarly with an early assignment of short calls and an inordinate borrow, and just the manner in which IBKR kind of treats some of that is I don't know, sketchy to say the least in our experience. But yeah, that's definitely a
Yeah.
real risk, and it certainly stings. And I noted, I tweeted earlier this week, if you're going to be short this over the long holiday weekend, that's a very expensive cost to incur.
Yeah, yeah. So I think right now on IBKR it says it's not available to short. I don't know about other platforms, but I mean, I think interactive brokers, they're the most popular platform among retail for shorting. I don't know if you feel this way from your experience. I don't know. I mean, um, they
I
they
personally have a very limited experience. I know I've shared this, and my personal accounts are mostly in IRAs, and obviously short selling is not something that is open to folks with assets in
yeah,
investment account
because
retirement accounts.
yeah, because I remember in December of 2020, I was actually watching this when this video came out in December of 2020 before the GameStop squeeze. Thomas Petterfy, the
Yep.
Interactive Brokers CEO, he went on and said that our clients are short a lot of naked calls basically, and
Yeah, I
that's what
remember
they
a
like to
lot. A
do.
lot of people got blown out going short GameStop via naked calls, because people. There's always risks in markets, and I think a lot of times people assume reversion to the mean, and yes, reversion to the mean does usually happen, but it doesn't mean it has to happen at any particular point in time, right? People think with GME in that January saw it run up from pre-split, let's call it low teens, and then it ran to 40, and then Citron put out their little short report, and I know a lot of people got absolutely blown out because then that Friday the 22nd, the stock ran up, January 22nd, 21, ran up and closed over 65. Every call on the chain closed in the money, and of course Mania week, that ensuing week was wildest week of my investing career.
Yeah.
Good stuff, Chris. If anyone wants to, again, opine on BBBY, if you're a bull, a bear, certainly happy to hear different perspectives. There's no, if you want to opine on the PLBY rights situation, and these other headline items that we talked about this week, like CPI and asset prices, the floor is yours. There's a time check. It's 5:01. So in case anyone's looking to raise their hand, if you are in the voice chat in the Discord, I'm looking. If you have submitted any questions, happy to field them. If you don't want us to hear your lovely voices, you could also try and again, I'm trying to unfortunately you guys are trying to let me know that the audio was out, and I was trying to do the broadcast, so I wasn't able to be looking at that screen while I was trying to share my screen, but I'm glad audio is working now. I'm not sure if I should recap the stuff that y'all missed. I don't know what you missed.
I was coming in and out trying to, because I thought it was on my end, but it was about mid BBBY. So I'm not sure how you had opened with the BBBY, okay, but I had missed the opening.
Yeah, so with BBBY, I kind of set it up with what they had reported last week, right? The delay of the 10Q, the going concern language. And the stock closed down that day 30% at $1.69 after that news came out. And generally speaking, and in the case of BBBY, there's a lot of folks who have to get paid before equity can see a penny. And if there were a liquidation, if there were, say, a Chapter 7 bankruptcy, and again, I'm not a bankruptcy expert whatsoever. So if there's anyone in the audience who is, wants to chime in, would certainly welcome them sharing their expertise. But there's the debt, there's the creditors, right, who have the 1 point whatever billion, Chris knows the exact number, of remaining outstanding debt that needs to be satisfied before. And look, I think a lot of people were very hyped. I think it's very important to remember, and none of us are. Look, Elon Musk agreed to buy Twitter in April of 22, and Ryan Cohen took a meaningful stake in BBBY and wrote the company a letter in March of 22. The financial market realities of March and April of 22 are very much night and day. When you think about access to capital, cost of capital, like the change is meaningful. So just because this was said a year ago, or this was said 9 months ago, whatever, I think it's really important for people to recognize and step back that even though somebody may have believed that, at that point in time, bona fide belief, that the market has very rapidly raised the cost of capital, locked a lot of companies out of being able to tap capital markets. We obviously talked about the PLBY rights offering, right? They diluting at all-time lows is awful for shareholders. It's very painful, but it's indicative of there's no alternative for them, and they're not the only one. I think it's safe to say that management has done a poor job with capital allocation to get to this point, and I've made it clear, and we've been calling for some time now for the CEO's resignation with that particular company, which unfortunately appears instead of that he has doubled down on a failing software platform, and it would rather ride into the ground than acknowledge defeat. But such is life. Management risk and governance risk is something that has been an eye-opening experience over the past year for me, and I'm sure for many other investors and other securities. We're talking about BBBY, right? I think a lot of people were thinking that they would be able to take advantage of the elevated equity price to remedy some of their problems, and they didn't. And again, with BBBY, right? You think back, 2 years ago or whatever, Mark Triton had come in and they were in this transformation. And unfortunately, they bought back a lot of stock that if they had that capital today, they wouldn't be on the cusp of a bankruptcy filing. They bought back shares, in excess of, I think it was on average in excess of $30 per share. Chris, if I'm off, correct me. But we're talking hundreds of millions of dollars of capital that was exhausted in the form of buybacks and that will be what kills the company if it does file, right? That prior management made these mistakes. Again, the situation changed very rapidly in the macro economy, and to some extent, you can't fault everyone for that, but that's where I think prudence and conservatism in your operations bear fruit, right? You need to be able to survive to keep playing the game. And once it's game over, there's no respawn like that in financial markets for equity holders.
Yeah, I was gonna say that Gustav Arnal, he's a CFO who
Rest in
sadly passed
peace.
away
Yep.
in August. I was talking to a guy, and he works in finance. He works for a bank, and he was saying that this guy didn't have like I mean, he had a CV, but it wasn't like of the caliber enough to run a company as big as Bed Bath and Beyond. He worked at some smaller companies. So like he was telling me that he's probably like, kind of in over his head, with the work. And then I remember there were some reports that he was, working like 18-hour days, 20-hour days. And with the situation of the poor capital allocation, right, the buybacks, right, and they also had a transformation plan where they spent hundreds of millions of dollars a quarter for like remodeling stores and doing some other stuff.
Right. They invested in the owned brands, which once Triton was out, and they kind of shifted back to national brands. Because I mean, their intention was to drive higher margins through private label product sales, and it just didn't click. And when he was gone and new management came in, they tried to shift back, but they just didn't have the remaining resources, it seems, to get the shelves fully stocked. I know I saw a lot of commenters noting, and I know you've said otherwise, I think, but that a lot of the stores were very under stocked heading into the kind of peak shopping season, and obviously the sales results
Oh yeah,
were
they
very
were.
disappointing.
They were understocked for
Yeah.
sure. They've restocked recently, but I think it's too late. I think they really needed to get that stuff, and I think they really pissed off their suppliers.
Exactly.
Their suppliers are angry. So
I don't have the number off the top of my head, and I could pull it up, but I don't think people care all that much. But when you looked at, again, when you look at financial statements, you need to at least, if you're making it, I think if you're trying to be an investor, you need to at least understand financial statements at a very elementary level. And there was such a huge benefit, I think I saw, from inventory drawdowns in the last quarter, which, that happened with GameStop, not on inventory, but with payables, right? They deferred their payables, so that was a source of cash. But like with inventory, not being restocked, okay, that was a source of cash in that net operating working capital went down, but it's like that's not sustainable. That's not, if you don't have inventory and you're a retailer, you can't make money. That's your business.
Yeah, and that's likely why they had to amend the ABL agreement. Bring it up to like the 1.1 billion was from like 800 million, and then the $175 million FILO loan. I think it was like three. Yeah, I think 175 million. Yeah. So yeah, and that's all secured debt. So unsecured holders won't get anything after those until those guys get paid. So I mean, I
think what's interesting is with the reporting yesterday from Bloomberg that that looks like there's somebody with a bid in. Let me pull it back up on my screen. So again, I'll just read what the story. This was from Thursday. after hours, so yesterday after hours, quote, the talks include the potential for a so-called stalking horse bid. Again, these are still talks that are ongoing. These are private negotiations that people are reporting on. The official word from the company is that they're still exploring multiple paths, but it sounds like, look, the PLBY asset, the company broke out last year, the beginning of last year, when the Cohen involvement was escalating, that in 21, the PLBY business generated, I think it was in excess of 1.4 billion in revenue, and they didn't give us a detailed breakout, but they said a mid-single digit EBITDA margin. So, the back of the envelope math was, say, 70 million midpoint there of EBITDA, which we don't know, what adjustments they're putting into that again. But 70 million in EBITDA from Baby, at least in 21. And obviously that's what Cohen had identified was what he was most interested in as the latent value. If you slap, for a retailer, let's call it a low teens multiple on that, you could easily see a reason for that business to be worth $1 billion. But that's where it gets back to, the company's not negotiating from a place of strength here, and a buyer isn't going to overpay, right? If a buyer can bid $1, they're not going to pay $5, even if it's worth 10. If that makes sense. Because I know there's a lot of speculation about M&A from folks, long BBBY and interested in BBBY. And I think it's just, you have to recognize that if people can get a better price, they're not going to overpay, and they'll get a better price and from a distressed asset than they would from one in a position of strength.
I think that's like what the staking horse bid was about. Basically, they would have a floor of the price, and then like nobody could bid under that. But I don't know how that's going to work out. It seems like
I'm going to pull up the bonds while you're talking, Chris.
The secured lenders will probably get everything. Maybe they don't even get paid all the way. I mean, who knows?
You said it's how much outstanding on the FILO loan? 600?
175 million on the FILO. There's 1 billion total of unsecured debt.
Because it's the first people to get paid are the secured FILO lenders, and then it's the unsecured bondholders, and then it would be equity holders.
The ABL and the FILO are together, and the ABL is likely $1 billion now. Not that they have to buy inventory.
That's the problem. Got it.
That's a big problem.
So yeah, the debt. Again, I pulled up FINRA. This data is, you as a retail investor can access it at any time. And I know I said it. I think in our 2020 last week, and kind of what we think for 23. Broadly, I think bonds are an attractive space, and credit is an attractive space. And for folks who haven't touched credit before and only know stocks and options, there's a lot of interesting risk rewards, I think, in the credit space. I'm not saying Bed Bath is, but you can see that the debt is trading at a distressed level. The 2024 bonds, the last sale, I see 9.5 cents on the dollar. The yield obviously is extraordinary, but it's a reflective that the market does not believe they're going to recoup much, if at all.
I think I searched bonds on Interactive Brokers, and it does it by yield, like globally. So like this is not just in the US, just global bonds. And I think Bed Bath & Beyond was second place. It had like 300% yield. Yeah. And then like a few places after, it was some Ukrainian company. Like that wasn't even the most yield. It was bizarre.
Yeah, when you look at the, obviously prices have an inverse relationship with yields. As price goes lower, yield goes higher. And it's a fantastic looking chart that I have up. If you go to the FINRA site and you look at the yield on those, that is truly the moon mission, is the yield on the Bed Bath bonds.
Precisely.
But yeah, the last trade, again, the bonds, look, what is it? The saying is that the bond market is smarter than the creditors are typically smarter than equity investors is the mantra. And yes, the bonds rallied, but it's not like they rallied anything to measure. And even in August, right? They didn't. So if I can kind of zoom in.
They rallied to like about 55 cents, the 2024 notes.
So here's again, if you're following on the visuals, otherwise if you're following the recording, you can of course see this. You can't see the screen, but I'll kind of look at the dates. So the bonds after Bed Bath reported earnings in late June, and the bonds on 6/28 of last year traded at 72 cents on the dollar. Over the ensuing 3 trading days, they got cut in half. They went from 68 to 34 cents on the dollar. That's Jake disclosed this at the time that Freeman Capital Management had acquired both the bonds and the common stock, and I know at the time also call options, but it had gotten down to 34, and then even on 8/4 when I think it started to get heated up, the equity started to get heated up. It was at 40 cents on the dollar, and it only got up to 54 cents on the dollar. So it went from 39 to 54. The bond market didn't buy it. It never got back to where it was, before that earnings sent the trader, even though the equity went to the moon. And in this case, it was kind of similar. If you look at just a shorter term chart, the bonds before this news came out last week of the going concern language were trading in the 22, 23 cent area. And then, they plummeted down to about a nickel, 6 cents. And, if you bought them at 6 cents and you sold them at 12 cents, you made 100%, which is what they were going for yesterday. But, they're down to 9.5 cents today.
Yeah, not very liquid.
That's right. Yeah. And again, this is not any sort of an endorsement of any of these, as I said in the disclaimer. We're just, we're all trying to, I think, again, this is a vital thing I hope folks understand. We're very young investors. We at Wook, we're trying to learn as well. We are hoping that over the years together, we'll all be able to learn and get better as investors. And as I hope I've made clear, we will never charge for any of being part of our community. It's not what we're about. You can check out our About Us. We're really, we wouldn't be here were it not for the lived experience we had crowdsourcing research together over the course of 2020. And that's how I met John, our CIO and founder. I met Joe through that. I've still never met Joe in person. It's an incredible time we live in, and I'm excited to meet Joe later this month. We're gonna have a little Wookie get together with the team, but crowdsourced research is incredible. The GME DD Discord is still going strong. Our Wook Discord is still pretty nascent, but we're going to be around for some years to come. It's as long as you don't get blown out, right? And there's unfortunately over the last year or two been so much of the YOLO mentality and the I'm going all in mentality. And if you blow your bankroll, you can't come back and play another hand. So capital preservation clearly is more in people's minds now than it was last year. It's just speaking personally too, but anyway, let me get off my high horse. And again, if anybody wants to come up, it's 5:18. Otherwise, I'll probably wrap within the next 10 or so minutes here. Hopefully this has been a good use of your Friday afternoon. Don't want to keep you. It's a nice long holiday weekend for those of us who work in this industry. Markets are closed on Monday. And hopefully your employer maybe, if not, it's going to be, I know most aren't going to be closed, but we will be back otherwise, as I said, depending on the poll results, which if I check, again, if you haven't taken the poll that's in the nest, we are going to begin our earnings call processes where starting next week, the plan is, if you haven't tuned in, we've done a few of these with Bed Bath, not Bed Bath, with GameStop, and we'll continue to do it with GameStop, even though we have no position. I have been obsessed with the business for a long time, and I know it pretty well. And there's a lot of businesses I don't know well. Most businesses, the vast majority of businesses. So these earnings calls are not going to be just businesses I know. We're going to cover companies. I don't know Netflix very well, but I think that my intention is somebody who, in my prior career at Ryder in corporate strategy and competitive intelligence, was listening to competitor earnings calls. And my hope is to use these earnings call processes to kind of teach people who maybe are more novice intermediate investors ways to improve their process and how they can kind of leverage following company earnings to improve their process. And even if it's a company you're not invested in, right? That's why we're thinking about covering United Airlines, because we think it's an interesting harbinger for what's going on in that aspect of the economy. Netflix, again, it's a consumer discretionary. What are they seeing from churn? Are they seeing that consumers are having to cut their bills because they're getting challenged? We've obviously talked about the inflated consumer debt has continued to grow, and the consumer savings rate is very low. So yeah, all that stuff, right? We're just trying to learn and get better, and we don't have all the answers, and we won't ever have all the answers, and that's why it's a crowdsourcing approach that we see as the path forward. We're going to look and see if there's any questions in Discord, or again, invite anyone else up. Any questions, comments, last words before we let the weekend get started?
I'll ask you another question if you don't mind. For this rally, because we've basically been in a bear market and we're seeing the meme rally. What are you looking for to personally, and I understand you're not giving out advice, but what are you personally looking for to acknowledge that it may be sustainable?
That's a great question. I think that, so we do these, I'll get back, I'll answer the question. On Wednesdays, we do these open mic conversations with Joe and I hosted on my personal handle at Rod Altman, and we were talking about this on Wednesday, how the financial markets are not the real economy, right? You could have a situation where they're moving in opposite directions, they're moving in the same direction, and the real economy over time, right, if the real economy is deteriorating, there's only so long the financial markets can remain elevated. But things that, like in the real economy that I'm looking at, and we've talked about what's going on in the purchasing managers data for ISM, manufacturing continues to contract and deteriorate. The services ISM purchasing managers index, the last one that came out, was the first contraction in many months. So the real economy does look like, when you look forward, these people that are doing the purchasing for these businesses have a lens into what's to come, whether it's new orders, right, and the manufacturing new orders deteriorating still and now pretty significantly contractionary. These are all signs that the real economy is slowing. The Fed rate hikes have had the effect desired in slowing housing. Other things are a little more lagged. So, like, if I were to think that a bottom was in, also, let me see if I can find the graphic, because there's a great graphic where you can kind of see sentiment and positioning. I think it's the AAII data, the American, I'm going to butcher it, American Association of Individual Investors. Okay. So there's a couple good overlays. But, if you were to Google AAII asset allocate, so they have an asset allocation survey, and they also have a investor sentiment survey. And asset allocations are still pretty high. They've come off the highs, but they're still pretty high. Sentiment is low, but there's a big disconnect between the respondents' positioning and sentiment. And historically, in these markets, there's a big puke, if you will, where people just drop their allocations meaningfully in equities. And yeah, they came down, but there wasn't anything like that. I would look to see more of a capitulation. I would expect to see more of a capitulation before this bear market's over. And I could be wrong. Maybe October was, and obviously with the China reopening going on now, there was a big run up in industrial stocks, which I've seen people posit that the run up in industrials was that the market was front running the China reopening, which is very good for the global economy. On the other hand, you've got World Bank just this week cutting global growth estimates for 23 again, and the Fed being adamant that they're not going to be cutting interest rates until 24. But no, that's what I would be looking at. Is I would want to see more selling. I would want to see a real sign of a capitulation, and I would look at things like allocations. There's I guess there's always like different ways to look at it, and Bank of America has talked about institutional cash positions are near multi-decade highs, and it's like, okay, yeah, they're up, but we're still talking single-digit allocations to cash, at least from the AAII data. The stock allocation is showing 64% as of the last month, so that's up a little bit, and that's still pretty high from historical. So obviously could be wrong, and we could be in the early stages of the new bull market, but I also then think about valuations, and while valuations aren't going to tell you that there's been a bottom, it seems it'd be pretty crazy to me to think that in a 4-ish% risk-free rate environment that forward earnings multiples troughing in the mid high teens would be the bottom. That just doesn't align with a lot of, I guess, historical market bottoms. But again, anything could happen. So hopefully that's a reasonable answer. Gives you some different resources to think about and look into.
Thank you.
You're welcome. All right, 527. Again, last call. If anyone wants to come up as a speaker, ask a question, any comments in Discord? I'm not seeing them. Joe, anything you got?
No, I think you wrapped up everything. I know there were some people saying they missed the used car topic because of the Twitter space glitching, so maybe you could just do a brief run over of that highlight again.
Okay. Yep. So let me put my screen back up. So yeah, I was talking about housing and auto prices, right? Housing prices, of course, are going to always be local. I talked about how in the headline, like you can see, if you see it on screen, the West Coast is kind of lagged. I think that's partially a byproduct of, you've had a lot of immigration from California and other higher cost of living in states in the Northeast into Texas and Florida. So the forecasts for both with the ongoing demographic shifts, and also with what's going on in the labor market, where a lot of the technology layoffs have ramped. Like that's been a sector most hit so far from layoffs. And I don't know if people heard it. I was talking about how blue collar jobs have held up remarkably well so far. We're not in anything like a recession today if you just look at the labor market. And that's the conundrum the Fed faces, that it sees how strong demand for labor is, and that average hourly earnings remain hot not in line with what would be stable prices. And that's why the Fed feels the need, because it cannot magically create laborers out of thin air. It cannot advise Congress to change immigration policy. It does its best to stay neutral, but it cannot solve the supply. So therefore its view is it must reduce demand for labor, and raising interest rates is the most, it's not a great tool, but it's the tool they have. And that's why they've kind of been so consistent with it. So higher interest rates, higher cost of borrowing, higher mortgage makes it so that your car, it's harder to afford. Your house, it's harder to afford. It should reduce the prices of those. The estimate for housing price reductions, again, it varies by geography. It's generally the West forecast to decline. San Francisco is the largest laggard in the Zillow estimate, at least. Tampa, unfortunately for me, as somebody who's looking to buy a house, is tied with Charlotte for the highest, with an actual forecast from Zillow of a 2% price increase. So the Florida, the Southeast, the Sun Belt, is expected to hold up better, and the Midwest a little bit more flattish. And then on autos, what I was kind of talking about was that in the Manheim Index on a year-over-year basis, and the example I used was that, all right, as of December of this past year, December 22, the year-over-year change per Manheim auctions and used vehicle prices is minus 15%. All right, well, if we go back to December of 21, it was a 47% year-over-year increase, and that's on the back of a lot of increases in the preceding year. So let's just assume, right, that 47% increase came off of a 100 base. So went from 100 to 147. If you're down 15%, that's still over 100. So used car prices likely have more room to fall as supply continues to come back online. The issue with automakers, of course, was that they have, especially legacy ICE engine autos, have a lot of very dumb chips, whether it's for the windshields or for other relatively benign tasks inside the automobile. These very basic bits of silicon chip were lower margin, and when everybody canceled their orders, many OEs canceled their orders in 2020. They kind of then got to the back of the line when demand for personal computing and Bitcoin mining and Ethereum mining and whatever went haywire. So the chip shortage, of course, constrained supply, which if you can't make new cars, you're not making new cars. And then the demand was also juiced by the stimulus. So people were moving around the country, relocating. A car is the best expression of freedom for a lot of Americans. You can just get in your car and drive and do what you want. So car prices just went haywire, and they're normalizing. They're going to keep coming down. And the question mark that I have, and I kind of noted with the bank earnings, is we're still at very low default levels. We're still near historically low default levels. While we'll get back to normal levels in 24 or later in 23 is kind of the expectation. If prices plummet too far, and if unemployment rises, which I mentioned the Fed in their summary of economic projections is calling for almost 1 million incremental unemployed Americans by the end of this year relative to the end of 22. So those folks are going to experience economic hardship if they don't have a safe emergency fund, if they're not able to find a job, if the market job market deteriorates. So those things should all challenge automotive lenders. Could challenge the balance sheets of companies who have those loans on the books. Your allies of the world, your CACCs, your retailers like your Carvanas and your CarMaxes. So obviously a lot of them have already taken it on the chin, but the question is how bad does it get? And, hopefully that recaps the part that got lost. But okay, I don't see any other questions then from the audience, and I think we've covered everything. So thanks everybody for tuning in to our second Wook in Review of the year, our 15th Wook in Review newsletter. We will be back next week. Again, if you are interested in taking the survey to inform which company we should begin our earnings call process on next week, we're either going to do United Airlines on Tuesday to kick things off or Netflix on Thursday. Take your pick. Whichever the voters call for is what we will do. We will start that call about 10 minutes before the company earnings presentation begins. So we'll kind of level set in the preceding 10 minutes. We will then play the earnings call from the company. And then we'll spend 30 to 45 to an hour afterwards kind of talking about what are the implications, what are any nuggets of knowledge that we were able to glean from the earnings call conference, et cetera. And we're going to, like I said, cover companies that I may not know at all or very little. I mean, I'll do my prep, but I'm never going to become an expert in a very short period of time. So I certainly hope other folks who do know some of these companies. I'm not a mega cap investor. So even though we're going to cover them, try to get a sense for where the macro economy is going. These are not companies that I intimately know. So if anybody is, well versed on some of these companies we begin to cover, we would welcome your insight and your participation. As the season goes along, though, we will cover some companies I know well. I'm excited to cover Allison Transmission, but I know people are not excited for Allison Transmission like I am. So we're certainly going to balance our picks between small cap, mid cap, mega cap, and well known and maybe less well known. So we can kind of give people a taste of everything. And yeah, our expectation is we'll do 1 to 2 of these a week. And of course, we have our book club, Margin of Safety. It's a legendary read. Seth Klarman did it 9 years into his investing career in the early 90s. He's been a beast at Baupost hedge fund for many years. They've had fantastic performance, and we're almost a 40-year track record. And their compound annual growth rate over that duration is, while it's not, I guess, publicized, it is in excess of 15%. And they only had 4 down years over that 4-decade period. So he's got the track record to prove it. We're going to go over Margin of Safety. The book club will be held on the last Tuesday of every month at 8 p.m. Eastern. So we'll have more good reads to come. And again, hope you read the book. Hope you'll participate in the discussion. If not, and you're interested in learning a little bit, hope that you'll tune in. And of course, all the content's made available on the YouTube after the fact. So yeah, let me then wrap us up. Thanks folks for tuning in. Hope everyone has a great weekend. Cheers, everybody.